You're now listening to the Tax Smart REI podcast, the number one tax podcast for real estate investors. Hey, thanks for tuning into this week's episode of the Tax Smart REI podcast. Today, we're joined with Ben Fraser, who is Chief Investment Officer of Aspen Funds and host of the Invest Like a Billionaire podcast. And we're going to be talking about strategies for the ultra wealthy. So we'll be diving into all of that in just 1 minute. Pure Property Management is recognized by Forbes as one of America's best startup employers and is transforming rental property ownership. The company helps you maximize returns through expert insights and proactive management. With a unified tech-driven approach and dedicated local teams, Pure ensures a hassle-free experience for property owners like you. Backed by over 2,000 years of combined expertise and with more than 12,000 five-star reviews, Pure has become a trusted partner for simplifying investment journeys and making rental property ownership truly rewarding. To learn more, visit rentpure.com. Again, that's rentpure.com. We'll see you over there, but for now, we'll dive right into today's episode. All right, and we're back. So Ben, thank you so much for joining us today. Would you be able to just give us a little bit of your background and how you got to where you are today for our listeners who may be introduced to you for the first time?
Yeah, absolutely. Well, thanks for having me on, guys. This is really fun. And Ryan just was on our show a few weeks ago, so go check that out because he dropped some major knowledge bombs there. And I was telling him before, I keep saying it to lots of different people because there's lots of good things there. But a little bit of my background. So like you said, I'm the Chief Investment Officer. I'm a partner at Aspen Funds. We're an asset manager, sponsor, operator. I've been operating for the past 11 years in different real estate verticals as well as non-real estate verticals. And, I joined 7 years ago, really to kind of help at that point, kind of be the CFO in training as kind of a VP finance, mid-level finance guy. But we were a small company, we were like 10 people. And, I just left a career in banking, but they quickly said, "Hey, we actually need to help us raise more money. We don't know, we're all friends and family right now, and need to kind of get beyond that." And so I kind of thrown to the deep end there, and have helped build the company. And we've scaled now to almost, I want to say, 900 accredited investors in our funds, raised over $250 million in equity across all of our funds and deals. And now have a team of about 4 people on that capital side that do all that. And then my role has really shifted more to the deal side, acquisition side, asset management, and running multiple different teams across organization. But before Aspen, my background was actually, like probably a lot of listeners were, W-2, kind of went the corporate path and really wanted just to learn as much as I could. So I spent a little bit of time working for a large kind of asset manager in alternative investments, but they were publicly traded, working with their institutional clients, kind of learning that whole business, and kind of first saw, some of these big allocations to these alternative investments that we talk a lot about on our show, Invest Like a Billionaire. And then I worked on the banking side of the world for a long time, commercial banking. I was an underwriter and then a lender for many years, looking at lots of different types of deals, commercial real estate, commercial loans to businesses. And one of the cool things I got to do was really look under the hood of these successful businesses and then successful owners of those businesses and see their personal financial statements, see their tax returns, see exactly, what they were doing and how they were making their money and what they owned and how they were growing their wealth. And so to me, it was very, very eye-opening. And, I decided, pretty early on, I didn't want to stay in banking for very long because, I kind of saw my career flash before me, and knew where I'd be in 20, 30 years, and it wasn't where I wanted to be. So left that, had the opportunity to join Aspen, which was a growing company at that point, kind of a young growing company. And we've now been going almost 11 years, and every day's exciting and new.
That's awesome. It's a pretty deep background, a lot of different experiences there, a lot of different things I'm sure make you a phenomenal chief investment officer at Aspen. Kind of diving into a little bit about today's episode. I know we're going to be talking about strategies for the ultra wealthy, but before we kind of dive into those strategies, what's defined as somebody who's ultra wealthy versus, say, high net worth individual or some of these other terms you hear out there?
Yeah, great question. It kind of depends who you ask, probably. I've seen a lot of different definitions. I think for like a lot of the big money center banks like JP Morgan, Goldman Sachs, these guys, ultra wealthy is usually between $50 to $100 million at least net worth. I think as the family office concept has become more common, where people, with kind of net worth, I would say 20 million plus, can leverage a lot of those same resources and strategies that the ultra wealthy do, that number's probably come down a little bit, but I would say at least 20 million plus. A lot of the data that we refer to comes from resources where the average net worth is probably at least 20 million. And I think that's a good barometer, right? Because they usually have the resources to do different things that maybe the average retail investor may not, and using that as kind of a guidepost to shoot for.
Awesome. What strategies are they using that maybe the average retail investor isn't?
Yeah, totally. So the whole premise of our show, Invest Like a Billionaire, is we started, diving into this world of alternative investments and of real estate, of private equity, of hedge funds, all these kind of more esoteric asset classes, at least they were to me when I kind of came into this space, was realizing that these large institutions were investing very differently than the average retail investors, right? And for most, what I'll call retail investors, in air quotes here, is someone that's got a net worth of say $1 million up to a couple $1 million, right? And they've, maybe built it through, putting money away into a 401k with an employer match. Maybe they've built some, rental income through buying short-term rentals, and they've amassed a little bit of a net worth. But a lot of times, most of that is concentrated, if it's the former strategy, in stocks and bonds, and very, very little in real estate. And that's what most people are in. If you look at the broad stats of retail investors, only 5% of their portfolios are actually in real estate. 95% is in stocks and bonds. But if you look at the institutional investors, the real big endowments, the pension funds, the family offices, these ultra high net worth investors we're talking about, by most data sources you can find, we talk about this on our podcast and can share all those, most of them are investing upwards of 50% of their portfolios into private alternative investments. And those are generally comprised of mostly private equity, which is buying operating businesses, and private real estate. There's some distinct advantages to why private has some advantages over public. One of them being volatility. You're not going to get the ups and downs like you get on a mark-to-market, huge public market that's a lot of times priced on emotion, priced on, what is the Fed going to do in rate cuts or increasing rates. And then the other big one is better tax benefits and better returns usually when you can go private. So those are the real advantages. And obviously you lose liquidity in most cases, meaning you invest in that piece of property, you can't readily sell it and generate cash quickly. And so that can be a downside, but that can be something that you manage. So at a high level, the big difference is generally large allocations to private markets, private real estate. And this trend has really accelerated because if you look back at, long tail data, this really started, I would say, in the 60s, 70s. This kind of became a more popular approach for these large institutions, really pioneered by the Yale Endowment, which is a fascinating story if you don't know the story of David Swensen. I'm actually writing a book right now called Invest Like a Billionaire, where it's centered around his story. And it's really, really interesting because he pioneered a whole new path that a lot of people weren't doing at that point. But it's become pretty commonplace for really the past half a decade for these large, allocators to do this. But just only really a decade ago was this even an option for retail investors. And that was really with the advent of the Jobs Act in 2012, which opened up the opportunity for accredited investors to invest in private deals that could now be marketed, right? Because prior to that, you could invest into private real estate as a passive investor, right? Or private equity or private debt, whatever it is, as a passive investor. But you had to know the sponsor personally. And most of these sponsors, they didn't want to work with small investors, so it was very, very difficult to get access. But now, with the Jobs Act of 2012, it's, in my opinion, it's a fundamental shift of capital markets. And if you look at most of the predictions, the allocation to the private markets is anticipated to grow on like a 15%, compounded annual growth rate for the next 10 years. I mean, it's going to be huge. There's already big numbers, right? It's like trillions of dollars, but it's going to continue to accelerate.
That's really interesting because, that makes a lot of sense. Like I kind of came into this world myself in like 2014. and really seen like a lot of people jump into the syndication space, the fund space on both real estate and private equity. And this is mostly with like $25,000 investments and $50,000 investments, things like that. I know that there's like crowdsourcing websites out there that allow you to get into even lower amounts. At this point, from a retail investor's perspective, if we just drill down into real estate briefly, say you have the option of buying a short-term rental or buying a single-family home, maybe for a long-term rental. Why would someone consider going from, going like, say, I'm going to go buy this house myself. I'm going to have a property manager. I'm going to have a GC who's going to help me renovate properties and do this entire thing themselves. Why would they maybe jump into passive instead, where they're just putting up the money into some of these private opportunities?
Yeah, it's a great question. I think will probably be debated for many decades to come, right? Because in my opinion, one is not better than the other. It's what are the goals you're trying to achieve? What is the outcome that you want, right? Because buying rentals, buying your own properties, doing short-term rentals, Airbnbs, doing development projects, doing other things on your own as an active investor, there's some great advantages. One, you can be a real estate professional. We talked about that a lot on my podcast with Brian, and that's like huge. But a lot of people don't want to go do that, right? Because if I'm a high earning income professional, I'm already pretty busy, right? And so I don't really want to go spend another 20, 30 hours a week learning how to buy real estate in a onesie twosie fashion, and probably take a lot more risks. I don't know what I'm doing. It's a big learning curve. It's a very competitive market, and it's a lot of time, right? For me, as a great example, I have 5 kids. I had my 5th kid a few weeks ago. And I got no time, right?
Yeah.
and the funny thing is, I'm a professional investor as my day job. I own 0 properties by my own capital outside of all my passive investments, other than my residence, and I have zero desire to. Because for me, the goal is I want more time, freedom. I don't want necessarily more control, and that's usually the two things you got to weigh and balance. Is if I'm going to go the active route, I have a lot more control, right? A lot of people like that. I like that. But I'm also giving up time, right? So if I'm investing passively as a limited partner in a syndication or a fund, the idea is you're transferring the control over to the operator, and hopefully they are going to make good decisions. In most cases, they hopefully will if they're established, been around for a while. And in most situations, if the distribution waterfall, the cash flow waterfall is such that I'm prioritized as an investor, my capital gets kind of paid out first. I have a preferred return. I have other things that benefit me as a passive investor. I can actually make as good or better returns, and they're doing all the work, right? And they're taking a lot of the risk by signing on the debt, and they're doing other things that I don't now have to do. And then the other piece of it, arguably, is they're going to have a much stronger competitive advantage in the marketplace than I would, right? Because so much of real estate, like any business, it's an economies of scale game to a certain degree. Obviously, there's niches that people can find, and you get good at it. But even the people that are doing rentals and doing short-term rentals and kind of building their own portfolio, you probably talk to these guys all the time. Like, it doesn't really get good until probably their 10th or 15th property, because you actually now know what you're doing, right? It took you a long time to kind of get to that point to actually find where the opportunities are, to actually go where other people aren't looking, and actually be smart about how you're structuring this or whatever it is. So in my opinion, for someone that is making a lot of money, they like the appeal of real estate, but they don't like the idea of being a landlord and getting the calls on the weekend and holiday weekend and late at night, and don't want to deal with that. Passive investing is a great option if you can get comfortable with handing over some of the control.
With the end of 2024 right around the corner, now's the perfect time to start planning what moves you're going to make to optimize your tax situation before the year ends and get a head start on 2025. Whether you're looking to use the real estate professional status, the short-term rental loophole, cost segregation studies, 1031 exchanges, or anything in between, our team is here to help you through proactive tax strategy and planning, painless tax filing, and streamlined bookkeeping services. After helping thousands of investors save millions of dollars in taxes, we want to help you. So whether you're looking to finish the year strong or get a head start on 2025, what are you waiting for? Head on over to to www.therealestatecpa.com/podcast to request a free 30-minute discovery call today. We're looking forward to learning more about your situation and how we can help. Again, that's www.therealestatecpa.com/podcast to request a free 30-minute discovery call. We look forward to hearing from you, but for now, right back into today's episode.
Yeah, and I think it's actually a leverage of like both sides, right? So if you're just an LP, I'm now getting to leverage your, like you said, time and skill and experience. And then as a GP, right, as the one who's kind of taking the money as a sponsor, you're not leveraging someone else's money, right? So it's kind of like this mutually beneficial agreement. That's why we're signing on the dotted lines, right? We're kind of saying, hey, yep, this makes sense. This is mutually beneficial. We know that we're kind of giving up some things because of the goals that we have. More time, more control, more money, more whatever it is, right? And I think too, like you can do both. We have several clients that will do some of more of the do-it-yourself. Hey, I've got a couple of short-term rentals or long-term rentals, and they've got a certain amount just in syndications and funds. Like you can do both. And some people like that balanced approach, or they might just say, hey, we don't want to put just all of our eggs into just passive, or we don't want to put them all just into this do-it-yourself approach. They want to kind of spread it out and kind of see which one maybe they think does better, right? Or they're kind of in a unique situation of life where maybe they had those more, 1, 2, 3 rentals when they were, single, or they were just getting married and they've just held these for 10, 15 years and they just haven't sold it yet, right? And now they've transitioned to, like you, Ben, I've got 5 kids. I don't have time to go buy another one of those. If I have any more extra income, I'm just going to push it into the passive. So absolutely, like people can do both. And I think it's important, like you said, for people to evaluate the goals of what they're really trying to accomplish with their time and with their money. I think that's fantastic.
I agree. I mean, I think the other angle of this too is diversification, right? Because I love the hybrid approach. I definitely would suggest that for a lot of people. The one big obvious benefit is if you're active, and you are married and you file jointly, you can use that real estate professional status. You can meet those thresholds, or the short-term rental loophole you talked about. And those are game changers, right? Because if you're investing in real estate, you want to be able to use all the losses to your advantage. And a lot of times you can't if you have mostly active income. I'm talking to the CPAs here, so I'm, you guys obviously know this way better than I do. But I think it's a great strategy, right? Where you can take both sides, where you can, invest passively, get those losses, and then be able to use them, to their full extent. The other kind of position I think is I've seen a lot of people do where they kind of build wealth through rentals, right? Because it's a proven path, right? If you want to go do it and you go get 1 or 2 a year, you just build over the next 10 years, like that's a proven path. A lot of people have done it. But then, yeah, at some point, maybe your appetite for that shifts, and or the risk shifts a little bit. And now all my wealth is concentrated in one asset class or one market or, one zip code. I want to diversify a little bit. And that's another big takeaway from a lot of these ultra wealthy investors is diversification is really, really important. I heard someone say this probably a year or so ago, and it was really, really powerful concept that I go back to all the time on my podcast is the concentration is a wealth builder, but diversification is a wealth preserver, right? So the idea is concentration of an activity, being really good at one thing, going deep in one area, gives you a disproportionate advantage to generate more, right? Build that wealth. But to preserve that wealth, right, to continue to grow it and spread it and have it grow over time without you having to work it, you need to diversify it, right? Diversification from day one isn't always a great option if you don't have a lot to diversify, right? If you have $100,000, that's all you got to your name. I wouldn't be so focused on diversification, but if you got 10 million that you've built and it's all in one asset class, you want to be thinking about diversification, right? Because that is as a proven mathematical, way to reduce your risk and preserve that wealth for the long haul. And so I see a lot of people that are entrepreneurs in real estate or any other business where they've built their wealth through concentration of one, being really good at one thing, and they're making this shift to that preservation mindset and even legacy mindset of how to pass on more to my beneficiaries through diversification.
Absolutely. Diversification is key. And you can definitely get that by being a limited partner and diversifying into multiple different opportunities with different sponsors and different locations, things like that, perhaps even different asset classes. One of the things that I found to be one of the most important things of investing as a limited partner, which is definitely the side that I'm on. And I took a few lumps on the head, perhaps. We'll see how it all turns out. But my question for you is, what characteristics, what things do you look for when you are evaluating a sponsor, right? Because sponsor is often the most important, or the operator is the most important part of a deal. A good sponsor can easily take a bad opportunity, turn it around. A bad sponsor could take an amazing opportunity, run it into the ground. What do you look for, or what things do you think somebody should look for in a sponsor when evaluating that?
Yeah, no, I'm so glad you brought that up. I mean, it's I get that question all the time, right? It's such an important thing, especially now we're kind of gone through a correction in commercial real estate, right? The past year and a half with interest rates going up, and a lot of people, the tide went out. We all kind of saw who was swimming naked, as Warren Buffett famously said, right? And that's it's a learning moment. But how do we actually take some of the things that we learned from this and apply that for our benefit in the future, right? Because what I've seen a lot of, right, to your earlier point, the syndication bubble, I call it a bubble, right, where everyone's raising for things, everyone's buying stuff, and it's really easy to raise money, right? A lot of people are making decisions and investing in things for the wrong reasons, and for the reasons that I've seen are, oh, that target IRR looks great, I want to get that, let me invest in it, and or, my Uncle Jimmy sent this over, and he seems to know what he's doing. I'm just going to invest in that deal with him, right? Those are like the two common things I see, is just looking at what's the target return and who sent me the deal. But I think people are realizing now, okay, maybe those aren't the only two things that I should check off the list to make sure I'm going to invest in a deal. And some of the things that I view from my perspective, being an operator, been around for over a decade, we've seen, I know a lot of people that are going through a lot of challenges and probably won't make it, right? And it sucks to see that, but you also can see the things and the patterns that were, happen to create that. I think one of those that I always say is, being good at marketing does not mean they're good at operations, right? And I think it kind of goes without saying, but a lot of people need to be reminded of that, is that a lot of times the people, that are doing the big events and doing the big webinars and other things, that great marketers and all the great content on social media, a lot of times that doesn't translate to operations and making good structural decisions. That means they're a good salesperson, right? And that's, you got to be aware of that. One thing I've also found too, in my opinion, again, is bigger is almost always better. And I say that a little bit tongue in cheek, but so much of the game of real estate is survival, right? And waiting for the right time to sell and being able to take advantage of the opportunities at the right time to buy, right? Because real estate is not linear. It's not just, hey, it's just great, I just sell at any point along the upward trajectory and I make money. It's, ups and downs and twists and curves and challenges left and right. And so you've got to be able to withstand all those challenges. And the more assets you have, the more liquidity you have, the more net worth you have, the more lending relationships that you have, the more you kind of build this bulwark, the more you can withstand those challenges. And then on both sides, take advantage of good buying opportunities because you actually have capital availability. And then also being able to navigate through the challenges to support maybe challenge deals or struggling deals to get to the point when it actually is a good time to sell again, and not right now is a bad time to sell, right? When you're being forced to because you can't make your payments or whatever. So I've seen a lot of smaller shops kind of just, they're not going to make it because they don't have the size. And there's just an unfortunate part of the business, I think, that scale does definitely matter. I think we say this all the time, but track record is so important, right? And when I say track record, I mean like true track record, not someone that's raising money for a deal that they're not the lead operator on and they're borrowing someone else's track record, right? And that's not necessarily a bad thing, but you got to be aware of that. A lot of times that people claim track record, it's not actually their track record. It's actually somebody else's track record. And then, there's how long they've been in the game, how long they've been doing this for, have they invested their own capital, what's been their experience, right? I want to see people that have been LPs and have invested through a cycle or two to know, some of these things that people are learning for the first time. And then I think, looking at operational performance, understanding what's the structure of the firm and the team, and, what levels of, how established are they? What, how many employees do they have? What kind of verticals do they operate in? What's the operational health of the operating company, right? Are they running a cash flow negative and trying to just live off acquisition fees every time they do a new deal, or do they have a good solid underlying business that can support, the growth and good staffing and those kind of things? So those are some of the things that first come to mind.
Yeah, definitely all important things. One of the things that I found recently is that track record is definitely important. Being around for a long time is definitely important. However, in one of the deals that I was in, it was like somebody had a really good track record for a really long time, and all of a sudden they didn't, right? So it's almost like it's not only important to look at the track record of what happened in the past, because that's definitely a strong indicator of future success. That's a strong indicator. It doesn't always guarantee it, right? Like sometimes I guess you might have to look under the current operations, under the hood. What is currently going on today, right? And how could what's going on today impact the investment that you're maybe making today, right? And I don't know. I have not found a good way yet to verify that in all cases, but a strong track record is definitely a positive sign, definitely a good sign to drill down for more.
Yes, 100%.
But I think if you just look at the track record and say, okay, this group had a phenomenal track record, and just make a decision today based on that, you could be putting yourself in a precarious situation, or at least I've seen that happen now. I don't know what your thoughts are on that, but it's just something that recently hit me. I'm like, okay, it's not just about the track record in the past, it's about what's going on today, not only within the asset class that you're considering, but also within the current operations of the sponsor that you're considering.
100%. I mean, Thomas, we could have an entire episode just dedicated to track record and all it is, because you're right. There's so much nuance there. Like one of the things I first comes to mind related to that is, okay, if you're going to show me all the deals that you sold in 2021 and 2022, I'm just going to throw those out of the track record conversation, because that doesn't really count, because the market went up like 15 to 20% each of those years. And if you just could fog a mirror and you sold a deal, you made a ton of money, right? And that's the market, right? So what I'm always trying to understand is what's the market and what's the sponsor execution that they drove home. So what I'm looking at a lot of times is I want to understand operational components of the track record, right? Because here's the flip side of that. Okay, maybe they're more of an emerging sponsor. Maybe they've been around 5 years or so, but they don't have a lot of exits, which a lot of people consider as like the full track record. And I won't invest unless they have like at least 10 exits. It's like, well, I don't know about that necessarily, because what really to me matters is how are the operational metrics of the deal performing, right? How much have they increased their net operating income? What did it start at? What did they take it to? What was the CapEx budget? And what was, how did they modify that going forward? And a lot of times a good operator can share with you their budget to pro forma, right? How good are they at, on the front end predicting what their goal is and how close am I getting to that? And if they're not getting to that, because again, hey, we all know this, there's a lot of assumptions that go into a pro forma, but understanding why and explaining why to investors, right? And being able to talk about that. Another big thing is transparency. Like the big question I always tell people to ask is, tell me about your worst deal and what happened. What did you do? Right? Because if anyone's been around long enough, the chances that they have a deal that didn't go well become higher and higher and higher, right? Because no one bats 1,000. If they say they have, they're probably lying. And what I want to see in that situation is, how do they respond to the challenges? Because here's the big challenge in any relationship, any partnership, any investment, is you're making a trust assumption, right? We're trying to trust but verify as much as we can, but a lot of the information you can't verify. So you're basing it off of gut sense and, some information you can corroborate. But a lot of times character isn't revealed except through challenges, except when the testing of the character forces them to make a decision that's difficult. And that's how I want to see how they responded. So in that conversation, I want to hear them talk about, hey, here's what happened. Here's what went wrong. Here's what we did to fix it. Here's what we did. We deferred our fees. We did X, Y, and Z. We did this for investors. We went through all that and we made a 5% return. But at the end of the day, we didn't lose money and we protect our investors' capital. That's a powerful, thing to hear. So
this is all excellent advice. I think people definitely need to take these things into consideration. There's definitely nuance, like you had mentioned before, when it comes to evaluating deals. And hopefully there's some takeaways in there for some people who are evaluating limited partnership opportunities, syndications. But before we get into like a little bit about what Aspen is working on and stuff like that, I definitely want to drill down into that a little bit. But what trends are you seeing maybe for as we head into shifting gears, right? What trends do you see maybe as we start to head into 2025 that investors, should be aware of and paying attention to?
Yeah, well, there's a lot of things we're tracking. It's the big thing that's been on the radar for a long time is inflation and interest rates, right? What's going to happen there? I am of the opinion, especially with some of the policies that we're seeing Trump now coming out and saying he's going to support, they're going to be pretty inflationary. And I think the risk there, obviously, is if inflation has a tick back up, right, it's going to put a lot of pressure on the Fed and with what they do on interest rates, right? I think we've been on a downward trajectory, but I don't know if it's going to continue that way. At a minimum, I think they're going to have to slow down the rate cuts, probably stabilize at maybe a long-term rate or short-term rate that is higher than what a lot of people expect. That's going to put more pressure on commercial real estate, which is inversely tied to borrowing costs. And in multifamily especially, I think we are in a really unique spot, right? I've been asked this a lot recently. I think in the short term, I think it's going to be a little bit choppy waters because we still have a lot of deliveries happening across a lot of the markets, meaning a lot of new product that's going to keep absorption low and keep rent growth low. We have a lot of deals that are having a maturity with their senior lender, and that's going to put a lot of pressure on lenders to either kick the can down the road on underperforming properties or take back properties. And then we've seen transaction volumes come way down because interest rates are higher and people can hit the cap rates they wanted to hit in prior years. So I think we're going to see a lot of sideways movement. There's going to be unique opportunities anywhere, and we're seeing a couple of those pop up here or there, but they're very few and far between. So we're kind of playing the multifamily market right now is in preferred equity or in mezzanine debt, where we're going lower in the capital stack, but we're still earning really good rates of return, mid to high double-digit rates of return. But we're usually, our last dollar in is at, say 75% loan to value. So, all the equity investors would have to lose 25% of their capital, or 25% of the value would have to go down. They have to lose 100% of their capital before we lose a dime. And we're earning a really nice rate of return being protected in the capital stack there. Another big trend we're bullish on is industrial, the reshoring trend, bringing manufacturing back to the U.S. This is not going away. This is a decades-long trend that I think is really, really important for investors to pay attention to. And then, we're also heavily invested in oil and gas, right? A lot of you guys are real estate investors or listeners might not be familiar as much with that, but I think it's a generational opportunity to be allocating some to oil and gas. We don't have time to go into it all, but the market is just ripe for opportunity for buying at really good values. Meanwhile, the bull case for oil prices to go higher is very, very strong over the next 10 years. So that's what we're looking at.
One thing interesting that you mentioned about the oil and gas, we've talked about that a bunch on the show and be curious to get another take on it. When it comes to oil and gas, like a few questions there is, are you looking at investing in working interests? And if so, what do you see as an allocation towards that for the retail investor? Because like ultra high net worth, I know we might have a few listening to this show right now, but like most of our listeners are on the retail investor side. If I'm a retail investor and I'm looking at oil and gas, how much should I consider putting in there as an allocation, to my portfolio?
Yeah, great question. Oil and gas is a unique asset class because it's similar to real estate in a lot of ways, and then it is very, very, very different in a lot of ways. And so I always tell people like dip a toe in to start because it's very different. Just like real estate, there's a lot of ways to play it. Don't invest in something you don't understand. And the way that we invest in oil and gas is what I would say very akin to a real estate strategy, like a value add strategy. What we go do is we go buy existing oil fields that are producing at a really good rate. We are generally buying what's called non-operated working interests. So we're buying working interests, so we get that upside, we get those tax benefits, but we're doing it alongside major operators. So we're massively reducing the operator risk, which in my opinion is the single biggest risk in oil and gas. Working with, multi-billion-dollar firms, most of them are publicly traded, and have a lot of capital to deploy and to be able to make things happen. And then we're buying that production at a really good value. So, comparable cap rate, number from a real estate standpoint is like 20 to 25% cap rate. So we're buying unlevered cash flows at, you say 20, 25% day one. Obviously, you have a depletion curve you got to beat, right? Because every time you're pumping that oil and gas out of the ground, you have less there and less for future production. So you're depleting the resources there. It gives you great tax benefits, but also, you have to basically, fight that curve is kind of a common phrase where you got to either continue to reinvest back into new drilling or just ride that curve down. So what we do is we layer in new drilling opportunities on top of that where you can get higher IRRs, you keep production up so you maintain overall asset value higher. And to us, it's a great way to allocate into a different asset class that, again, I think is ripe for opportunity. From an allocation standpoint, again, dip a toe in if you're, a lot of these things that are, maybe more esoteric, a little bit out there, maybe, you don't want to start there. I think start with the stuff that's bread and butter, start with the stuff that you know really well. And as your net worth increases, I think you can take more risks in things like oil and gas. But, I don't think you want to have more than a 10% allocation there. And I'm not an advisor, so that's a number I just made up. But in my opinion, you want to be very limited to exposure there because there are higher risks you're taking there.
Within the oil and gas, are you looking at it as a cash flow play, or are you looking at it? I know you mentioned value add, but so for example, you could get, for people who are looking for cash flow, there's debt funds you could look at, and obviously it depends. It varies a lot, but maybe you're getting it towards the upper end. You're getting it the 12%, maybe 18% I've seen on some deals, but it's usually kind of in the mid-teens, somewhere around there, lower to mid-teens, at least from what I've seen. And then there's real estate that has cash flow components to it, but I rarely see the actual physical real estate cash flow returns on the cash flow be that high, right? I've not really seen them creep up maybe into the double digits too often. I guess what I'm asking is, do you look at oil and gas as a good cash flow investment, something that somebody could invest in to tap into and get cash flow?
100% with the right strategy, right? And that's why I say there's so many ways to play it. What I see a lot of people do in oil and gas, which is not necessarily a bad strategy, but very, very different, is investing in pure drilling program plays, right? Where you're investing into a new well being drilled with no existing production. There's great tax benefits with that, right? You got your intangible drilling costs, your tangible drilling costs that are pretty awesome. Let's just be honest, right? And you could potentially use those against active income if you structure it right. To me, the challenge with that, and we did a lot of research before we kind of made our first investment, and I saw a lot of those types of deals. But whenever I dug into track record, as we talked about, I saw a wide variance of outcome. And to me, variance of outcome is the definition of risk, right? So if you have, some that do really well, but most do okay or do terrible, that's not really, you're not really necessarily playing an investment at that point. You're kind of taking a gambling risk and you're getting tax benefits. If you're okay with that, if that's what you're looking for, that's probably could fit in the portfolio. But from my standpoint, I want something that actually has value, that has cash flow, and also has some tax benefits, kind of the best of all worlds. Now, we don't get the same level of tax benefits we do because we have so much production that is producing so much income that you don't always get past that and to tap into the active income. But it can be a high cash flow investment if you're buying existing production and you know how to manage that production well. But yeah, we're one of our funds, it's producing high teens net cash flow to the investor, and it's predicted to go over 20% cash flow over the next year or so. And again, past performance is not indicative of future performance, but those are the kind of things you can get right now in the market if you can find the right deals. And so, yeah, I love it as a cash flow play. It's a tax benefit play. And ultimately, we're playing the long game because I do believe, we are not going to even be close to hitting the benchmarks that all the energy agencies want us to hit for green energy. And we're shooting ourselves in the foot right now with fossil fuels where we're not producing, we're not reinvesting back into the ground to increase our future production. So supply is going to be limited. Demand is going to be the same or higher by most estimates. And we all understand basic economics, right? That's a recipe for higher prices.
Yeah. Any other best practices? We've talked a lot about being a limited partner, finding an operator, different types of investments, diversification, stuff like that. Any other just kind of final words of, best practices in alternative investing as a whole, as you're maybe talking to the audience? Any other best practices?
Yeah. education is the single best investment you can make, right? We all, if we had a career in a corporate world at all, you spend a lot of time, right, in going to school, taking tests, learning things before you ever got a chance to go and try it out in the real world, right? And I think the same should be the case for investing. It can be the Wild West sometimes, and you want to take the same amount of effort that you put into earning your income. You should put as much or more effort into learning how to preserve and grow that wealth, right, and that income that you're saving. So, to me, education is so important. If you're just kind of getting started in alternatives, get into communities. There's a lot of them popping up around where you can plug in, learn from other people's experiences, from other people's mistakes, and get shortcuts to those things that we can all learn from. And education's the big one. And then just go slow. I mean, we all want to hit these goals quick, but what I find a lot of times people are just getting into it. They make all these investments because they have cash, and then they look back a couple years later, and they probably would have not made 75% of those investments now, based on what they've learned, based on the things that they've done since then, and in the learnings they've had along the way. So I think it's, experience is a powerful, teacher, but you can't have experience without time. So I think you gotta have some discipline in just being disciplined and, set an allocation you want to allocate per year and just stick with that and then grow it as your income and your net worth grows. But don't go all in too fast because you might regret that.
Yeah. And I think as maybe some of our listeners are, younger and getting started out with building wealth and things like that, you don't want to probably put, 50% of your net worth into, just alternatives depending on where you're at, right? That's why, high net worth individuals can have some of that, they've already got that base of wealth that they can kind of put things into more risk, right? If you're just getting started, you got a young family, you're, working full time, you might want to be a little bit more cautious and kind of set that good base for yourself first before you get into that. But just the last question, and we can kind of wrap up. I'll let Tom take it after this, but tell us just as we wrap up, what would make Aspen Funds unique or interesting to people, and who is kind of a target, ideal client, investor, I don't know what you guys call them, for you guys. So just tell us a little bit more about you as we kind of wrap up.
Yeah. So we work with accredited investors, and our kind of unique proposition, I kind of shared a little bit along the way, but we're not like a lot of operators in that we're a hammer and everything is a nail, right? We do one thing and that's all we do, and we have to keep doing that thing even if it's not a good time to do it. Our approach, I'm one of 4 partners. I'm the youngest partner by about probably 25 years. And my other partners, they have been through a lot of cycles, seen a lot of things, had a lot of experience in different asset classes. And it's really made us very well-rounded, and we can see the bigger picture, right? That's our secret sauce. Our tagline is macro-driven alternative investments. We want to look at first the big trends going on. Where is the opportunity driven from economic fundamentals, right? What are the things that you can't just change on a whim? Where are those opportunities? And then how do we go create strategies that can take advantage of those opportunities and build the best-in-class teams and structures around them for investors? And then we invest all our own money alongside LPs into every deal, every fund that we put out. So we're well aligned. And this is our biggest way that we allocate our own personal resources and net worth is in our own deals. So it's a very aligned model. It's what we think is the right approach to investing, where there's different times to invest in different asset classes, right? There's better times and there's worse times, and timing really does matter, right? So it's important to be investing in the right asset classes in the right time.
If an investor wanted to learn more about Aspen Funds, or perhaps take the next step in terms of like looking into what you guys have, and what would be the best way for them to do so?
Yeah, you can check out our website. It's aspenfunds.us. Our podcast is Invest Like a Billionaire, and you can check it out at thebillionairepodcast.com.
All right, awesome. So we're going to go ahead and drop all of that into the show notes for everybody who is listening. Ben, really want to thank you for joining us today. It's been a great episode, and I'm going to have to go check out this podcast because it sounds like there's a lot of insights in there that will be beneficial. So thanks again for joining us, and we'll see everybody next week.
Thanks for having me, guys. Really fun.